You're not imagining it. Your groceries cost more, your rent costs more, your fuel costs more, the coffee you buy on the way to work costs more, the holiday you used to take without thinking twice about it now requires a spreadsheet. And when you ask why, when you actually try to get a clear answer, you usually get something vague about supply chains, or geopolitics, or things being complicated, which is true, but it's not the whole story. The whole story is about money itself, what it is, where it comes from, who decides how much of it exists, and why that has everything to do with the number on your grocery receipt. This is that story, told plainly, without agenda, and without the parts that usually get left out. Ready to take your first real step? Get the guide, Buying Your First Bit of Bitcoin, $15, link in the description. Let's start with the word everyone uses, but almost nobody explains properly. Inflation. Most people understand inflation as things get more expensive. Prices go up. The cost of living rises. That's accurate. But it's only describing the symptom. It doesn't explain the cause. Here's a more precise way to think about it. Inflation isn't really about prices rising. It's about money losing value. When there's more money in circulation, chasing the same amount of goods and services, each unit of money buys less than it used to. So prices, measured in money, go up. Not because eggs became more valuable, because the money you're using to buy them became less valuable. That's a crucial distinction, because prices going up feels like something that happens to you from outside. Your money losing value points directly at who's responsible, whoever controls the money supply. Between 2020 and 2022, the United States money supply grew by more than 40%. In 2 years. The Eurozone, the UK, Australia, similar stories, different numbers. More than 40% more money. Chasing roughly the same amount of groceries, rent, fuel, services. Your grocery bill is the receipt. Your rent is the receipt. Every price that feels impossibly high right now is partially a reflection of what happened to money before those prices changed. So where did all that extra money come from? Who made it? And why? The answer involves two actors, banks and governments, and it's more straightforward than most people expect. Let's start with banks. Here's something that surprises almost everyone the first time they hear it. When a bank makes you a loan, a mortgage, a car loan, a credit card, it doesn't lend you money that already exists. It creates new money, digitally, from nothing. The bank types a number into a computer. Your account shows that number. You can spend it. It's real. And it didn't exist before the loan was made. This is called fractional reserve banking. We touched on it in episode 4. Every time a loan is made anywhere in the economy, new money enters circulation. And more money in circulation means every unit of it buys a little less. Then there are governments and central banks. Central banks, like the Federal Reserve in the US, the Reserve Bank of Australia, the Bank of England, have the ability to create money at a much larger scale. The mechanism has different names depending on context. Quantitative easing, bond purchases, stimulus packages, but the underlying action is the same. New money enters the system, usually a very large amount of it, usually quickly. This isn't a conspiracy. It's openly documented policy. Central banks publish what they do. The question isn't whether it happens. It's whether most people understand what the consequences are. The two biggest recent examples are 2008 and COVID. After the 2008 financial crisis, central banks around the world created trillions in new money. to stabilize the financial system. After COVID began in 2020, governments worldwide sent stimulus directly to households, and central banks created more money still. The US alone created more money in 2020 than it had in the previous 200 years combined. At the time, much of this felt necessary. Economies were collapsing. People needed support. The debate about whether it was the right call is legitimate and ongoing. But the consequences were predictable, and the consequences arrived. On your grocery receipt, on your rent notice, in the price of everything you buy with money that is now worth less than it was. Now here's the part that most coverage of inflation leaves out entirely. Inflation doesn't affect everyone equally. Some people benefit from it. Some people pay for it. And the split is not random. There's an economic principle called the Cantillon effect, named after an 18th century economist named Richard Cantillon, who noticed something important. When new money is created, it doesn't appear evenly throughout the economy. It enters at specific points, through banks, through financial institutions, through government spending. The people closest to those entry points get access to the new money first, before prices have adjusted to reflect its existence. They can buy things at yesterday's prices with today's new money. By the time that money filters through the economy and reaches wages and savings, prices have already risen. The people at the end of the chain, workers, savers, people on fixed incomes, pay full price for the inflation without having received any of the benefit. Put more simply, inflation makes people who own assets richer and makes people who hold cash poorer. If you own property, stocks, a business, inflation tends to raise the value of those assets. Your net worth goes up even if you did nothing. If you hold your savings in cash, in a bank account, in a savings fund, inflation erodes the purchasing power of that cash every single year. The number in your account stays the same. What it can buy gets smaller. This is why the wealth gap between people who own assets and people who don't has grown so dramatically over the last 2 decades. It's not purely about income. It's about what inflation does to different types of wealth differently. And here's the thing that changes how you see all of this. This isn't a malfunction. It's not a side effect that nobody anticipated. Inflation at low controlled levels is official policy in most economies. Central banks have explicit inflation targets, usually around 2% per year. The intention is to discourage hoarding cash and encourage spending and investment. Whether that's good policy is a legitimate debate, but the point is, your money losing value over time is a feature of the system, not a bug, not an accident, the design. Now, why are we talking about this on a Bitcoin channel? Not to tell you what to do with your money, not to frighten you into any particular decision, but because understanding Bitcoin requires understanding what it's a response to. And the story of your grocery bill is exactly that context. Bitcoin has a fixed supply, 21 million, written into the code, unchangeable. No government can decide to create more because of a crisis. No central bank can pursue a policy of a little inflation is healthy. No election, no emergency, no pandemic can justify printing more Bitcoin because it can't be done. The supply is fixed, not by politics, by mathematics. That's a genuinely different relationship between money and value, not better in every way. There are real trade-offs and real debates about what fixed supply money means for economies, but different in a way that makes complete sense once you understand what's happening to the money you already have. This episode is not financial advice. It's not a recommendation to buy Bitcoin or sell anything you currently hold. Those are decisions only you can make, ideally with a financial professional who understands your full situation. What this episode is an explanation of something that's affecting your life right now, that most people have never had clearly described to them. Your groceries are ridiculously high because the money you use to buy them is worth less than it used to be. That didn't happen by accident, and understanding it clearly, without panic, without agenda, is the beginning of making better decisions about your own financial life. The financial system is not complicated because it has to be. It's complicated because complexity serves those who benefit from your confusion. Understanding it, the way you now understand why your groceries cost what they cost, is not a small thing. It changes how you see every financial decision in front of you. If you want to understand more, the Bitcoin for Girls curriculum, episodes 1 through 11, covers all of this in depth. Start at episode 1 if you're new. And if you're ready to take your first real step, the guide is in the description, Buying Your First Bit of Bitcoin, $15. Bitcoin for Girls, the building of a beautiful future. See you in the next one.